In today's episode, we are going to be talking about what can you invest in a self-directed account? Like what differentiates a traditional retirement account from a self-directed account, and what are the different types of investments? We'll talk about equities, real estate investing, notes, loans, syndications, crypto, precious metals, private businesses, startup businesses. We'll even talk about unique investments like bull semen. You hadn't thought about bull semen? This is an episode you don't want to miss. To help us with that, we got Edwin Kelly. Welcome back to the show, Edwin. How are you?
Jose, I'm doing great, man. In fact, I was feeling a little rock and roll today, so I ditched the sport coat and threw on a leather jacket instead.
Don't worry, I'm wearing basketball shorts underneath, so we're good. So let's talk about a traditional retirement account. This is what I used to have. I used to have a traditional retirement account. Let's walk us through what type of investments do traditional accounts invest in? And then what are the different types of investments available in a self-directed account?
When you think about traditional investments, and that's the world that I started out in, right? So in that world, what people invested in with their retirement accounts was something that we referred to. We can get real technical on it, but I'll just keep it high level and just say it was marketable securities. I mean, that's pretty much what people are investing in if their accounts at a bank or a brokerage. The most common type of investment that people are buying are mutual funds, right? I mean, that continues to be the most common investment type, I'd say, for most people. Now, what happens is when you get to a certain net worth, meaning you've got a certain number of assets sitting at the bank or brokerage, then all of a sudden they say, oh, well, you've got enough money now that you go to our private client group and now you get to invest in separately managed accounts, which is basically a fancy name for a mutual fund. Right? So a lot of it's the same thing. But generally speaking, if somebody's investing in a retirement account at a bank or a brokerage, it's going to fall into basically stocks, bonds, mutual funds, or CDs. That is going to make up most people's portfolios, with the biggest concentration being a mutual fund or some derivative of that.
It's funny because that's what I was exposed to. Like whenever I had my retirement account with ADP, they gave me 4 or 5 different mutual fund options. It was a growth fund, a retirement fund, and something else. And I had to invest in one of those because that was all that was available to me. Now, one thing that I didn't realize is, do mutual funds have fees? And how big or small are those fees generally?
That's a great question. And it's interesting because when you compare the traditional world to, say, the self-directed world or alternative asset world that we're talking about, there are fees in mutual funds. In fact, it's interesting because when I ask people the question, well, what do you pay for your retirement accounts now? The most common answer is, oh, well, I don't pay anything. And it's like, really? So you have your account with a firm that owns some of the most expensive real estate in downtown Manhattan, and they were able to purchase that because you, as one of their clients, pays them nothing. Right? I mean, it doesn't make sense. So, but the challenge is that when I was in that world, when I was in the Wall Street world, we had something what we called hidden fees. Right? They're hidden. They're hidden because and I'll just use you as an example because you brought yourself up. So we'll use you as an example, right? You would get a statement from the bank or brokerage firm where you had your retirement account, and it had the mutual funds in it. And you get your statement, and it would show you some information about the fund. The QSIP. It would show you the beginning value, change in value, that kind of thing. But you never saw a line for fees, right? So it's real easy for people to think, well, I must not be paying anything because I don't see any fees on my statement. That's why we call them hidden fees, because where the fees are disclosed is in a document called a prospectus. And the prospectus is like a magazine or a booklet. I call it a magazine because it's about that thick, right? It's like a magazine. And it's the first thing that goes in the trash can when it's mailed out to clients. Nobody reads it because it's basically 30 to 50 pages of SEC legal disclosures, right, that are required by a management company to disclose. And it's in that document that the fees are disclosed. And it doesn't tell you your specific fees. It just tells you what the fees are and how they're charged. So you would literally have to take that, multiply it by your account value to figure out what you're paying. Nobody does that, by the way. And I know nobody does that because one of the things that we've done at times with clients is that when a client says, well, I'm not paying anything. Well, okay. So we'll pull up. So if we're on a Zoom call, like we're doing, right, kind of like now, right? Well, we'll pull up Google and go to Google Finance, and I'll just type in the QSIPs, and it pulls up the data sheet basically on that mutual fund. And it's one of the things on that data sheet are the expense ratios, right? So I can pull the expenses and calculate across their account balance, and I can show them dollar for dollar what they're paying. And people are blown away. They have no idea how much they're paying for this stuff. So yeah, there's fees involved. The challenge, and I'll just point out a challenge with those types of investments. One of the challenges with those investments is that they're all correlated, right? They're all Well, I'll say there's two challenges with those investments. One is that nobody understands what the heck they're investing in, and I'll demonstrate this here in a second. But the second issue is that it's all correlated to the market, right? And so I've had people who are my age now, right, and just based on the length of hair between you and I'm guessing I'm older than you are. And so people in my age category will get calls to this day where people say, look, the market's gone up a lot. It's treated me well lately. But the problem is that I've been through a couple resets and I've been through enough cycles that I know it is a cycle. It goes up and it goes down. But I'm at age now where I can't afford to have my account cut in half again. I don't have enough time to recover it. And so people are saying, I want to diversify, not necessarily get out of it completely, right? But want to diversify away just being in something that is tied to the stock market that goes up and down, and nobody knows when it's going to go up and nobody knows when it's going to go down, right? That's why there's volatility in the stock market. So one of the big opportunities for people self-directing is to diversify away from that and to get away from investments that are correlated to the stock market and the economy in that sense, right? So they eliminate two things when they switch from, let's say, a traditional investment portfolio to self-directing, in that one, they oftentimes will reduce fees. And the second thing is that they can manage volatility in a different way, right? And reduce that in some cases.
What's the highest fee you've ever seen on a mutual fund? Just to kind of get an idea. And the reason I asked that is I was obviously invested in mutual funds, but I didn't really see my account growing. I'm guessing I never did the exercise that you did with clients, but I'm guessing it was because I was earning a decent return and there was a decent amount of fees associated with it. What's the highest you've ever seen associated with a mutual fund, just out of curiosity?
Yeah, so it kind of depends on the firm and how they set it up and charge it and what the product is. So there are some accounts where the brokerage will say, hey, look, we're going to charge you 1% for fees. Now, this may not, don't hold me to this, but I'll just say that there's a very well-known brokerage that their average fee that they're charging clients is at about 2.5%, or at least it was when I was working in that world, right? The interesting thing is there's an organization called the ICI, the Investment Company Institute, which is a nonprofit financial research organization, and they publish something every year called their Investment Company Fact Book, and it's like a 200 to 300 page report with all kinds of interesting data on the financial services industry. And in there, it will show average fees, right, charged. So that's usually what I look at when I talk about fees with clients, because everybody's in a different situation with different companies that they work with. So I use the ICI to look at averages. And the averages are around, when you actually add in all the fees that plans and these companies charge, it's usually around 2%. Now, where it can be higher than that is if somebody's buying a variable annuity. A variable annuity is an insurance product. So typically fees and commissions are significantly higher on those. And one way to kind of see that is that if you own an annuity, there's what's called a surrender charge. And a surrender charge, I believe it's 7 years on that before it goes to zero. And the reason why there's a surrender charge of 7 years, meaning if you were to cash out of that investment in less than 7 years, you're going to pay some percentage. And you can actually call the insurance company or the annuity company that you have it with and say, hey, do I have a surrender charge? One. And two, what is it if I were to liquidate it today? Well, why is there a surrender charge in an annuity? Well, because the commissions are pretty
Enormous.
high, in my opinion. So this is my opinion here. Commissions are high on annuities, and the agent who sells that product gets paid up front. So in order to pay that commission but not have the client see it come out of their account, they what happens is the company basically finances the commission, right? So it's paid to the there's a loan taken out, the commission is paid to the agent or the broker, and then what happens is through the higher fees in the annuity, those fees are pulled out year after year up to the surrender period, the end of the surrender period, 7 years, to pay off that loan. If you were to cash out, they haven't paid off the loan for the commission to the agent yet, which is why there's a surrender charge. They're recapturing the balance of the loan, i.e., the commission that was paid to the agent. And so this is why, again, in that world, we call them hidden fees, because nobody knows that this is how it works, right? Nobody ever sees these things itemized on their statement. They're disclosed. It's just people don't know where they're disclosed. And even if they do know, then they have to go do the calculations themselves to figure it out. So the fees, I'll just say range. But I will say this is that when people step into the self-directed world, whether you're in mutual funds, annuities, separately managed accounts, or whatever, the fees, just to protect myself, I'll say 90% of the time or better, you're saving a significant amount of money on fees when you self-direct your retirement account versus go a traditional route.
Yeah, and even for I mean for annuities, I've heard because I had a annuity broker on the podcast, and he mentioned to me that they could be as up in the 5% range for the fees of the commissions that they get paid on the annuity. So do the math. Like let's say that you are earning a 7% return on your mutual fund, but you have 2% in fees. The reality is you're really earning 5%. If you have 8% annuity, but there's 3% or 2% or whatever it is, you can subtract that, and it kind of makes it so that at 5% or 3%, if you're earning 5%, you're subtracting 2, and that's really you're only left with 3%, which means you in some cases you may only be keeping up with inflation, which is kind of not very helpful if you want to grow your retirement account. So let's get into the self-directed, and this is what I liked about it as well too, that I feel like it's more transparent than the other side. So let's talk about investing in real estate. Can somebody buy a piece of property in a self-directed account with their retirement account?
Yes. So I could make this really, this could actually be the shortest podcast ever, in that when the question comes up, what can you invest in with a self-directed IRA? The answer is virtually anything you can imagine. Right? I mean, that's the short answer, and it's an accurate answer. You can invest in virtually anything you can imagine, so long as we do it according to the rules. Now, the way it works with retirement account investing, there are rules around self-directing, and the rules come from Internal Revenue Code 4975 and IRC 408. So 4975, 408 are the two internal revenue codes that kind of govern prohibited transactions when it comes to retirement accounts. Now, here's the interesting thing about it. The way the rules are written when it comes to retirement accounts are written the same way that they write the rules on every other aspect that the government kind of governs our lives. So let me explain what I mean by that, because this is really important for people to understand. There's no rule that says somebody has to be nice to me, right? So if somebody was mean to me and I called the police and I said, "Hey, this person was mean to me," they would say, "Well, okay, stay away from them." Right? There's not. What do you want us to do, right? And the reason why they're asking that question, "What do you want us to do?" is because there's no law broken. Because there's no law that says somebody has to be nice to me. But now, if somebody walked up to me and punched me in the face, and I called the police, I said, "Hey, this person assaulted me," that person could get arrested and charged, right? Because there's a law in the books that says you're not allowed to physically violate someone's person. So a prohibited transaction in the retirement code, if you will, is just that, right? These are the don'ts. So the government tells us what we're not allowed to do, not what we're allowed to do. So if it doesn't say we're not allowed to do it, we're generally allowed to draw the conclusion that we can do it. So, perfect example. There's no place in 4975 or 408 that says you're allowed to buy mutual funds in your retirement account. Doesn't say that. However, there's no place in the code that says you are not allowed or prohibited from buying mutual funds in your retirement account. Therefore, millions of Americans, we all draw the same conclusion. Well, then we're allowed to buy mutual funds in our retirement account because there's nothing that says we can't. So what we're looking at are the don'ts because the do's don't exist, right? So that's where I say when you look at the don'ts, it's a short list. It's an extremely short list, which is why I say you can invest in virtually anything that you can imagine, right? So when we're talking about asset categories, the don'ts are collectibles, which what is a collectible according to the government? Jewelry, rugs, antiques, certain types of coins, alcoholic beverages, things of that nature. Another thing you cannot purchase inside of a retirement account is life insurance, right? Life insurance is prohibited. Those are the two main things if we're talking from an investment perspective, looking at this through an investment lens, that are prohibited. So basically, if it's not a collectible and if it's not life insurance,
You can buy it.
there's a really good chance we can invest in it. So as an example, real estate, right? Real estate's not prohibited. Therefore, we can draw the conclusion, yes, we can invest in real estate. So people say, well, what kind of real estate? Well, anything. Commercial real estate, vacant land, farmland, residential real estate. You can invest in fact, by the way, we're processing a transaction this week. A client is purchasing a property in the British Virgin Islands with their self-directed retirement account. You can buy real estate in New Mexico, where I'm sitting now today. You can buy it in Las Vegas, where I own a home as well. You can buy it in California. Don't know why you'd ever want to do that, but you can, right? You can buy it. So you can buy it anywhere in the country. You can buy it virtually anywhere in the world, like the British Virgin Islands, if you want.
Now, what are the?
Which, by the way, that investment, interestingly enough, the client's buying this. I believe it's a condo. Okay, so he's buying this condo in his self-directed IRA in the Virgin Islands, and it's an Airbnb. So just an example of some things. I mean, when I say you can invest in virtually anything you want, I mean that's a pretty good example, right? Buying a property in a destination type of place and Airbnb the thing out.
As it relates to buying a rental property in your retirement account, what are the don'ts on that? Meaning, could I live in the property if I buy it in my retirement account? Could I collect some of the cash flow? Could I do any of the work, basically?
Yeah, so that's a great question. So when your retirement account owns a rental property or a piece of real estate, the big don'ts are number one, no use of any kind personally, right? So that's a big one, and I think we kind of addressed that in a previous episode, right?
Yeah.
So if people are interested in that, there are ways, like depending upon what your goals are with the property, there can be ways to look at that transaction. I won't go into that now because we discussed it in a previous podcast. Go check that one out if that's something. If you're interested in using it at some point personally, go check out our other podcast that we did, right? Because we addressed that issue. Correct. And there's something there that might be beneficial to people on that topic. But so the two big things are no personal use and no, you cannot provide a service to any investment that your retirement account owns. So like what you brought up, if it needed painted, like you can't paint it, you have to contract that out. Basically a service to real estate would be anything that you could consider sweat equity in a sense, right? That's a good way to think about it. If it requires sweat equity, that's probably going to fall under the category of a service. That's a no-no.
So let's talk about real estate loans. What are real estate loans, and what's the difference between secured and unsecured? And then what are the don'ts in real estate loans?
So there's kind of two sides to a real estate transaction, right? There's the property and there's the paper. That's how I like to think about it. Another way to think about this is, because I love making things simple, because when it's simple, people, we can just go execute them and do really well. So when you're investing, there's only two roles that your retirement account is ever going to play. Okay. When you're making an investment. So there could be all kinds of sophisticated instruments and all kinds of things out there, but this is the great thing. We just want to simplify things there. So your retirement account is only going to play one of two roles. Your retirement account is going to be an owner, or your retirement account is going to be a loaner. It's only one of two things, right? So in the first part of the scenario we just talked about, that's being an owner, right? You own the piece of real estate, the client's going to own it and rent it out. The other side of that is somebody has to fund that deal. Now, in this case, he's using his own IRA and cash from his IRA to purchase this Airbnb. But if he didn't have the cash to purchase that, his retirement account could borrow that money. So now you or I, with a retirement account, we could create a note and loan money from our retirement account on a real estate transaction. In that case, what does our IRA own? We own the note, right, or the mortgage. The other party owns the property. So in that case, we're not responsible for any of the liability or risk associated with the real estate itself, right? We also don't get the reward in terms of the equity increase or any of those types of things. What we do get is a promise to get our money paid back at a certain time with a certain rate of return. And to your point, secured would be it's actually recorded against the property. So you could force foreclosure if they defaulted on the note. The property cannot be sold or transferred without, right, your note being paid off. That's the benefit of secured. Unsecured is just that, right? There's no underlying security. So you are trusting and operating on faith that the person borrowing the money will pay it back. And so there's not necessarily a claim against any asset that you could go recapture if the note is defaulted on, right? Your only recourse at that point would be to work it out with the investor, or take some sort of legal action to collect.
I love it. And we did a different episode on notes as well too. I just kind of wanted to briefly touch on that. So if you are interested in learning about how to invest in real estate notes, or how to be the bank, how to hold the paper for people when buying deals, there's a full episode on that strategy. What's a syndication? So I mean, if somebody is used to investing in mutual funds, stocks, bonds, CDs, the word syndication might be something that they haven't heard of. What does that mean, and what are the different types of syndications that are available?
There's certain investments that I group into category, right? Just for sake of discussion, because they're similar in how they operate. Syndications, PPMs, private equity. I kind of group all those together, right? Because what it is, what those investments are, and it's very, very popular choice with many self-directed clients that we have, is that the benefit to an investment like that is that you have somebody who's an expert real estate investor that is used to dealing with larger projects. So these are typically things like apartment complexes or commercial properties. When you're starting to talk about syndications or private equity, those types of things, or a large portfolio of single family homes, not one or two offs, right? So you're talking about substantial number of units. You're talking about valuations of assets in the multi-million dollars range. And you have a professional manager who's acquiring those assets and managing those assets. But what is needed is capital. And so what they do is, because it is a larger investment, they're able to open that up and allow investors to participate in that investment, right? So often the way it's structured is that you buy in and you own a percentage of that investment, and the rental income is distributed out based on the percentage of that investment that you own, right? And the other thing that's interesting about those investments is that, and I've seen this quite a bit, where it's kind of, there's like two kind of strategies when clients invest in syndications. What I have observed is that one is that they will go in and a syndication is set up to go in and acquire a specific property, like an apartment complex. And that typically cash flows within the first 12 months back to the client or back to the account. And what happens is that there's a 5-year plan typically in place, right around 5 years, where as those units go vacant, the property manager will go in, rehab the unit, raise the rent, with the idea that within 5 years, they'll be able to work through most units, get them rehabbed, get the rents up. And as you know, right, property value is based on the income. So then what happens is 5 years out, they sell it uh, at a multiple based on the current rent roll. And so there's usually a payday at the end, and then that investment wraps up. So the account would receive income during that 5-year period of time, and then a payoff at the end. If that is in fact a strategy, which, like I say, I see that. I've seen that quite a bit with the real estate syndications in the last several years. That seems to be the trend of how those are organized.
So there's different structures in the syndications. Obviously, there's limited partners, and then there's also like debt offerings. I'm imagining like where you're just a lender on some of these syndications. Can you do the like just be the person that loans the money to some of these syndications as well too, very similar to the real estate loans?
Like I said, the great thing about it from the IRA standpoint is that you're either an owner or a loaner, and whenever these investments are put together, um, there can be different ways to buy in. In fact, I'm always evaluating investments for myself, and so like I was invited to participate in a syndication, and that one was to invest in Class A, or the first round of fundraising. Right. I just got notification yesterday that closed out, and now they're going to do another round, but that's not going to have the same benefits and rewards. Right. It's going to be structured differently than the first round. So yeah, there's all kinds of ways. I mean, that's the great thing about it, is that this is what I tell people is like, one of the challenges people have in the beginning when they start self-directing or they think about self-directing, some people like you, it's like, hey, I have more investments that I can shake a stick at, right?
Mm-hmm.
Than I have money. And so your challenge is raising money or getting more money to do more deals. When people are starting out, the problem is the opposite of that. It's, hey, how do I find my first investment? How do I find my second investment? How do I find my third investment? We actually teach the process to finding investments. We don't do that, right? We don't sell, recommend, steer, or advise on any investment. We're a passive custodian, but we can educate people on how to go find their own investments and how to self-direct their own accounts. And that's one of the value adds that we provide. And what happens is once people start to really learn that process and develop the skills of self-directing, that's exactly the challenge they run into, right? There's more opportunities than they have money. So that's kind of the nice thing about it. To your point, are there ways that even one investment or one investor might offer different options? Yeah, we see it all the time, right? That they have different types of investment structures set up because not every investor is looking for the same benefits.
Yeah.
So this is another advantage to self-directing, because it's almost like you can figure out exactly what you want out of an investment and then sort based on your criteria, right? You can't do that in the traditional world, but you can do it in the self-directed world. You have way more control and information over what you're doing than what most Americans are doing in that plain vanilla traditional world that we all started out at.
What about crypto and precious metals? What are the don'ts in crypto and precious metals?
The big don'ts when it comes to crypto, and I'll say, well, it's definitely true with precious metals, and I'll say it's also true, in my opinion, with crypto, is that you do not want to have personal possession of the asset. Okay. Um, so when our clients purchase physical precious metals, we actually work with a trust company called Delaware Depository, and they are a precious metals custodian. And they actually hold physical precious metals. Um, and they have contracts with like the Mercantile Exchange or Chicago Mercantile Exchange, like, big organizations. And so we contract with them. So when a client of ours would buy physical precious metals, as an example, that you can choose any depository you want, but we have it set up seamlessly with Delaware Depository so that if a client were to purchase physical, say, gold bullion or whatever, they purchase it, it's owned by the IRA, it gets shipped to Delaware Depository, it's held at Delaware Depository. You can turn on a video camera and see your own gold sitting there, right? But the point is, you don't want to have personal possession of it, right? There was a case. Now, by the way, I get that there's a lot of people who advertise, and I hear this all the time. Oh, we'll show you how to buy, physical precious metals in your IRA, and you can keep it at home in your safe. Yeah, that's a no-no. I can tell you that right now. There was a case several years ago called the McNulty case, and McNulty, I believe it was a female. She bought physical precious metals in her self-directed IRA, kept them at home, and the IRS ruled that a prohibited transaction. Right? She was found in tax court. She was found guilty of a prohibited transaction because she actually had. There's two criteria. The number one thing that the judge ruled on in that case was unfettered access to the assets because they were in her house. Right. So the big no is, and I guess we could throw it in that personal use category, right? You just like the real estate. This is the big thing that the government doesn't want. We're giving you these tax benefits and asset protection benefits through these accounts. It's a trust. Therefore, you have to treat it accordingly, right? These are not your personal assets. These are the assets of the trust. And therefore, you can't have unfettered access. That defeats the whole purpose of the system. So that's really the big don't when it comes to, we can say that with physical precious metals. We can say that with crypto, right? But you can say it with really any asset. The key is you do not want to have personal use of that asset. That's the big thing you want to.
Let's talk about private businesses and startup businesses. How can somebody invest in a private business? How can somebody invest in a startup? And then what are the don'ts as well?
The way you get involved, and I'll say this, see, self-directing is in our DNA. And when I say that, I mean that very literally. So when I launched Specialized, right, it costs millions and millions of dollars to launch a financial institution, as you could probably imagine, right? And I didn't have millions and millions of dollars in my pocket laying around to start a company. So I had to go out and raise the money. And so again, this is the space I know. So the very first investors were self-directed retirement accounts, right? Because I knew that's where the money was. So when I went to launch my business and I went out and started raising private money, that's where the initial money came from, was self-directed retirement accounts. Obviously not here at our firm because we didn't exist yet. So the business was not in place yet when we started raising money. That was the point of raising money. And so private businesses and startup businesses, that really depends on your network and who you know, right? So I began approaching people that I knew, looking for capital. And I said, if you know anyone who would be interested in an investment like this, then, you let me know and make an introduction. And so that all came through, one-to-one. Like, for me anyway, I'll say it this way, is that for me, raising money for private businesses, when I start something, that always comes from a one-to-one relationship, right? I'm talking to someone, I talk to someone else, I talk to someone else. Oftentimes, if it's something they're interested in or they're not, they say, I know somebody who I think might be interested in something like this. Let me make an introduction for you. And that's usually how it happens. At least that's how it's happened in my experience, right? So private businesses and startup businesses are usually something based on your network. Again, networks are things we can create and expand. So this isn't just something that happens to you. You can be very intentional about how you do this. I have been throughout my career.
What are the risk with investing in private businesses? Like, meaning, like, how do you remain in control? Like, let's say I'm raising money for my business. How do I set it up so that the people are money people versus actual decision makers in the business? And what are the risk? Meaning, like, are they secured against the business only, or do you guys get like, do people get like personal guarantees or different things like that whenever something in this space happens?
Yeah, so it's a great question, and I'll say investing in businesses is not for the faint of heart. So I'll say that right off the get go. Typically, there is no security. Personal guarantees offered.
Don't
I can
need
say I
much.
didn't offer personal guarantees, right? I didn't want to do that, right? That's the whole point. That's one of the benefits of having a business is that you want to limit your liability.
Yeah.
But it does depend, right? So some people will offer personal guarantees, but oftentimes I would say they don't. I know I didn't. Um, I invested 2 years ago in a startup. It's a software company. I bought 5% of the startup. I believe I'm at five. I'm still at 5%. 5%. And the advantage to when I bought it, and this is where, like I say, you have to know what you're doing. When I bought in, I put an amount of money in that investment that I said this could be like a home run deal, right? I could get an infinite return because software, right? It can just take off and become $1 billion valuation, or it could fizzle out and become nothing, right? It's probably going to do one of those two things. I knew that going in. So I didn't put more into that than I was willing to risk losing 100% of my money, right? So that's how I look at startup. They're very, very, they're very risky, right? 95% of businesses don't last 5 years. Like there's a 5% chance of success. And of the businesses that last and can get to profitability and last beyond 5 years, less than 10% of those will ever break $1 million a year in revenue, not profit, revenue,
Revenue. Wow.
right? So, so to beat those odds, right? I mean, that's a higher risk proposition. So I think the big thing, if somebody's looking at investing in a startup business or an existing business, um, make sure my the biggest don't is don't put your life savings into that, right?
Yeah.
You only want to risk, in my opinion, and this is just my opinion, uh, you don't want to risk more than you're willing to lose 100% of. And
Yeah.
so if you say I'm not willing to lose 100% of anything, well then it's not for you. Like that's the easy answer.
It's interesting because in one of the videos you also mentioned to me, so it sounds like the risk is higher, but also the reward could be a lot higher than some of like these real estate deals. I think you mentioned to me that there was a account that invested in a certain startup or a couple startups, and that startup took off, and now they have a very healthy retirement account because the business took off basically. But unlike real estate loans, a lot of those real estate loans can be secured by real estate, and if you invest or you loan at a certain um, loan to value ratio, then you're pretty secure because there's an asset behind it. In a business that may not be the case, but it's also like, okay, what is the business idea? What are the chances of this succeeding? Who are the operators? What's their track record in this field? So there's a lot of due diligence that has to be done. So let's talk a little bit about like unique investments and anything else that you want to add. So I think off camera you mentioned to me some of the unique investments can be like vending machines. People buy vending machines. People buy X-ray machines and lease them out to other doctors. Bull semen, I think, was one of them. Cattle. We talked about a little bit about loans for cars as well too. Can you go over some of these unique investments and how they're structured?
Yeah, so this is where people can get really creative. And I would and here's what I always tell people is that I can't tell you how many times I've heard people say, "Oh, you know what? I came up with this great idea for this product," right? Because they've identified a problem and they're like, "Man, this product would solve the problem." And so I say, there's investment opportunities all around us if we just pay attention. And so this is what I kind of throw into that category of really interesting kind of investments. And I could give you all kinds of scenarios, but I'll just give you a couple. Um, so to that first point, there was a client years ago. He was a traveling salesman, and his territory was the Western United States, and he would drive through Montana. And so when he would drive through Montana, there was a particular area where there was just no cell service, right? And so what he ended up doing was having his retirement account. So he did some research, and he found out like there's contractors, right? Um, just like there's contractors who build houses, there's contractors who specialize in building church buildings, there's contractors who specialize in building cell towers. So he bought a little plot of land and had his IRA buy this land, build a cell tower on this piece of land, and now that cell tower is owned by his retirement account. And every time somebody with AT&T or T-Mobile or Verizon or whatever drives through and hits that tower and is on the phone, right? There's a certain percentage that Verizon, AT&T, and all these companies pay to his cell tower that now goes back to his retirement account, right? So that's just an example. He owns a cell tower in the middle of nowhere. So that's one example of like I put in the interesting category. I have a client who loves racehorses, super into horses. Well, horses, right, who are out for stud service, there's big money. I'm not into horses myself, but so what I know I've learned from a client who's really into it, and so she invested in a horse that then right they pay for that horse to quote impregnate another horse to develop future baby racehorses. Um, the same thing holds true with like the bull semen, right? Now with bull semen, they can do in vitro. So there's certain bulls that, for whatever reason in the livestock world, right, that they want like it trades like a commodity, right? And so livestock is big business. Livestock typically has like a serial number or something, right? They'll stamp the ears or whatnot. They tattoo it. And so people will invest in livestock. You'd be amazed at the level of creativity that I've seen people invoke. I've seen people who were in the timber bit, like in the paper business, buy, or I should say, they didn't buy, they leased or bought an option on trees. This one guy, really clever guy, he was in the paper business, so he knew what kind of trees would make good paper. So when he would come across some land that's just basically out in the middle of nowhere that's got a bunch of trees on it, he'd find out who owns it and say, "Hey, would you mind if I'll pay you 10 grand to take an option on the trees on this land, like this parcel." Mm-hmm. And what he would do is he would take the option in his retirement account, and then he would go sell the option to one of the paper manufacturers that he dealt with, and they would go harvest the trees and pay a premium for the right to take over that option. I mean, just like that's why I say like the possibilities are just endless, really, honestly. I mean, you and like I said, keep in mind, there's only two roles the IRA is going to play: an owner or a loaner. So if you can figure out something where you see an opportunity that you could monetize somehow, there's usually a way to structure that so that it would be an investment that you could hold inside of a retirement account.
And could you wholesale real estate inside a retirement account, very similar to that option agreement that the
yes that is possible, because remember, we're looking at what is prohibited.
Okay.
Yeah. So like exactly. So that's what he did. He had it. He wrote an option. It was owned by his Roth, and so that was an option contract. Yeah.
Is there a limit to how many wholesales you can do a year or anything like that? Like, let's say I run a wholesale operations.
No, there's no limit. There's no limit on how many investments you can do inside your retirement account. The issue isn't whether or not, it's not about volume or number of transactions, in my opinion. However, if you operate a business in your retirement account, that's not prohibited. You're allowed to do that, but businesses are always taxable. And I think we might have talked about that in a previous podcast as well, right? So investments are not taxable. businesses are taxable. So do you own investments in your account, or are you operating a business in your account? Both are possible. You can do both. One's taxable, one's not, right?
I love it.
So that's just the issue to be aware of there. Yeah.
Now, what if somebody wanted to have both options? Like, meaning, what if somebody wanted to do the mutual funds, do the stocks, do the bonds, do the CDs? Is that possible in a self-directed account still, or no?
Yeah, the self-directed IRA can hold a brokerage account. So yeah, that you can do that in a self-directed retirement account for sure.
So it basically just gives you more options. Basically, with one account, sounds like you're restricted. With the other account, you have everything that's legal by the government, basically.
Yeah. So here's kind of how I suggest people think about it. If you have a retirement account at a bank or a brokerage, you're handcuffed. You're handcuffed to the things that they sell. If you have a 401k at a company that you don't own, right? So it's somebody else's company that you work for and your 401k, you don't have handcuffs, you have a straitjacket on you, right? And it's when you have a truly self-directed retirement account that you're allowed to do anything and everything allowed by the government, right? So it really comes back to how much control and access do you want over your money. If you believe that you want to have control over your money, that you care more about it than anybody else, then a self-directed IRA or a self-directed retirement account, because there's different types of accounts, self-directed retirement account is going to give you the most control and the absolute most freedom. IRAs or retirement accounts at a bank or brokerage house, less freedom, 401k, super restrictive. So again, that's just kind of the tier and the hierarchy, if you will, from least amount of control to the most amount of control.
Anything else that you think people should know about investing or what they can invest in a self-directed account?
Yeah, so I think here's one of the suggestions that I make to people when they're thinking about this, and it's not uncommon that I talk to people who have and the specific dollar amount's not important, right? It's the concept and the principle that's important here. I've had people say, well, it could be $50,000, it could be $5 million, but it's like I've worked for how many years to accumulate this amount of money. I really like what I'm hearing about self-directing, and I want to do it, but at the same time, I'm not sure I'm comfortable with it yet, right? Because I haven't made a lot of investments, or maybe I haven't made any outside of mutual funds yet. So I always tell people, it's like, look, it's your money. You can start with whatever you want. There's investments that you can make self-directing at any dollar level. Now, truthfully, the more money you have, the more options you have. That's with anything. But you can make an investment at any dollar level. So I always say, it's not an all or nothing proposition. If you think you want to diversify away from some of the things you might be doing now, whatever that is, then setting up a self-directed account, you don't have to transfer all your money. You transfer some of it. How much? Whatever you're comfortable with, right? You could have $500,000 in a retirement account, but if you say, you know what, I'm comfortable starting with $50,000. That's all I'm, because this is new to me. Then start with 50. Keep 450 where it's at. Move 50 into a self-directed retirement account and start the process there. And then as you get more comfortable and you have more success and you gain more experience, you can transfer more, right? There's no limitations on transfers. So I just say start where you're at, but if what you're doing right now isn't getting you where you want to go, you've got to do something different. But it's not an all or nothing proposition. There's ways to stair step this over.
Edwin, where can they find you if people saw value, or where can they find more information about your company?
Yeah, so go to www.specializedtrust.com. I'm giving away my latest book for free, and we'll also give you a strategy call with one of our self-directed specialists. They'll be happy to spend 45 minutes to an hour on the phone if you want to take that much time, or whatever time you want to allocate to that, to get all your questions answered, talk about your personal situation and how self-directing can impact that for the better.
Well, Edwin, I want to say thank you for coming on the show. For our viewers, we had Edwin Kelly with Specialized Trust Company. We talked about what you can actually invest in a self-directed account versus a traditional account. We talked about real estate investing, real estate loans, syndications, crypto, precious metals, private businesses, startup businesses, and then we even talked about unique investments. If you've enjoyed this episode, make sure to hit the subscribe button. If you feel that this episode will be helpful, make sure to hit the share button. Thank you again, Edwin. Appreciate your time as always. And to our viewers, until next time.